Shares took a dive on Wednesday, with broad-based losses weighing on the market, although blue-chip names CBA and QBE provided a bit of relief from the general gloom. The SP/ASX 200 fell 49 points or 0.9% to end the session at 5,652 for its second loss in 3 sessions. The All Ordinaries Index dropped 44 points, or 0.8%, to finish at 5,719. The Australian dollar traded at US 78.6, climbing through the session after hitting a low of US 77.9 on Tuesday afternoon in the wake of the Reserve Bank of Australia's monetary policy decision. Unlike the US share market, which has started the month of October by notching fresh record highs, the ASX is struggling to stay within the trading range it has been trapped in since the middle of May. Investors are worried about the prospect of higher interest rates coupled with lackluster earnings growth as an economy burdened with debt-laden consumers and low-wage growth struggles to make headway. Retailers, both discretionary and non-discretionary, were under pressure on Wednesday, with Myer down 3.1% and Harvey Norman lower by 3.4%, while supermarket owners Wesfarmers and Woolworths fell 0.8% and 1.8%, respectively. Recent economic data has encouraged consensus to become more constructive on the outlook for the Australian economy in 2018, Morgan Stanley analysts wrote in a note to clients. However, we believe that challenges for Australian households will see a further decoupling from the global recovery. The broker's research suggests that higher mortgage rates will put more pressure on household consumption. Bank stocks fell sharply again on Wednesday, with Westpac down 0.9% and NAB 1.2% lower. ANZ was the worst performer in the sector over the session, ending the day off 2.1% after a broker downgrade. CBA, however, outperformed peers, adding 0.3% after analysts at Bell Potter upgraded the lender to buy, saying that the market had overreacted to the potential fines from its alleged non-compliance with anti-money laundering regulations. Insurer QBE was taking back some of the previous session's steep losses, trading up 2.8% after Morgan Stanley analysts said it's time to buy. Rival Suncorp also advanced, adding 1.2%. Miners were lower. BHP dropped 0.6%, Rio Tinto declined 1.5% and Fortescue lost 2%. Lithium miner Galaxy Resources bucked the downward trend, however, rising 2.4% as it advanced for the 5th day in a row. Galaxy jumped almost 6% on Tuesday after inking a supply deal with Tesla battery supplier Panasonic. A2 Milk extended its recent powerful run, climbing another 5% after it was upgraded to buy at Goldman Sachs. Best and worst ASX performers. New Zealand milk futures are down 0.7% today. ANZ Bank New Zealand rural economist Con Williams noted that a recent whole milk powder prices auction disappointed. The market appears to be banking on a rebound in New Zealand supply, which is dependent on improving weather conditions, he said. The auction confirmed that the only thing that has been holding whole milk powder and butter prices up recently was short New Zealand supplies, he said. Chinese demand has been spectacular and other Asian and Middle East buyers have struggled to absorb the higher GDT supply. All up, softer New Zealand production could still see a milk prices of $6.75 kilograms, but if not, it seems something around the mid-NZ $6 is more likely. Milk futures are lower. Photo supplied Rupert Murdoch has stepped up his attack on tech companies such as Google and Facebook over their increasingly dominant market position, which is eating into the revenues of traditional publishers such as News Corp, and undermining their business model. In a message to shareholders published in News Corp annual report released on Wednesday, the octogenarian media tycoon vowed to continue to contest the abuse of the marketplace by some big tech companies wherever possible. This is an era where publishers, and the economy and society at large, are affected by the behavior of a small number of technology companies, Mr. Murdoch said. Without naming the companies, he said the tech giants were using their dominance to the detriment of many. News Corp has attacked Google in the past, accusing it of being willing to exploit its dominant market position to stifle competition and being a platform for piracy and the spread of malicious networks. Newspaper publishers are seeing their revenues eroded as advertising dollars follow consumers to digital platforms such as the social network Facebook and Google, which have become powerful content distribution platforms in their own right. News Corp chief executive Robert Thomson said the impairments were made as the company fully recognized the challenges facing print-based businesses and ensured that the company is fully focused on the future. The digital duopoly had a responsibility to recognize the provenance of premium content and prevent the proliferation of false news and vile extremist propaganda, Mr. Thomson wrote in the annual report. It is crucial that algorithms are not used to discriminate against quality journalism and that societies have an informed debate about potential algorithmic abuse. The media giant has begun working with Facebook and Google on a subscription model which could help bring more readers to our mastheads and fundamentally change the content ecosystem, he said. Read more here. The headquarters of News Corp, in New York, photo Sam Hodgson Bell Potter upgraded CBA to buy from hold on Wednesday, with the broker saying that value has returned to the stock given the recent pullback in its share price. The bank's market value has declined by around $14 billion since a U.S. TRAC launched proceedings against the bank on the 3rd of August, the broker noted. After assessing some key US and UK AML/CTF cases, we conclude that the most likely maximum penalty would be in the $1.2 billion to $1.3 billion range, and the market has materially overreacted to a US TRAC's actions. Bell Potter said that, in the absence of any published US TRAC methodology for calculating penalties, it is of the view that using a template from the FCA will provide a reasonable estimate of what CBA could expect. It is also of the view that the penalty will be more than covered by proceeds from the likely divestment or IPO of CBA's global asset management business Colonial First State Global Asset Management, which is estimated at up to $4 billion. CBA shares are down 0.4%, outperforming the market which was trading down 0.8% in the afternoon. Bell Potter upgraded CBA. Photo Wayne Taylor house hunters are steering away from Sydney and Melbourne and turning their attention to Brisbane, according to property data group CoreLogic. Investors are being turned off by affordability constraints in Sydney and Melbourne, and the sentiment that both markets are currently at their peak, CoreLogic head of research Tim Lawless says. More investors and prospective buyers are now looking at Brisbane, as recent migration growth and improving job prospects make it more attractive, he said. Queensland's unemployment rate has tumbled in recent months, falling from 6.5% in June to an 18-month low of 5.7% in August, the Australian Bureau of Statistics says. I think one of the missing pieces of the Brisbane puzzle up to date has been the fact that there hasn't been much jobs growth, Mr. Lawless said. This is one of the reasons why we haven't seen Brisbane values growing to the same extent as Sydney and Melbourne, despite affordability and the decent rate of population growth. It hasn't been a very strong economy, but that seems to be changing now. In the past 12 months, Brisbane's home prices have jumped 2.9%. That compares with a 10.5% increase in Sydney and a 12.1% rise in Melbourne. But Mr. Lawless said an oversupply of apartments could have investors treading cautiously. In September, the Reserve Bank of Australia said Brisbane was still at risk of a potential for an oversupply of apartments which would drag property prices lower. RBA Assistant Governor Lucy Ellis then said second-hand apartments will likely fall in price as tenants move into newly built homes because they are nicer and rent is still low. The Brisbane skyline, photo Michelle Smith back to top. Getting into lithium has lit a spark under the Mineral Resources share price, pushing up the Wealth of Financial Review rich lister Chris Ellison in recent months. Mineral Resources shares have surged 80% since July 23, making it one of the best stocks on the All Ordinaries index in that time. Ellison is the managing director of Mineral Resources. Its business is built on its mining services arms, processing, site operations, and, increasingly, logistics. But it also partners with mining companies to develop new assets, with a view to securing more services work and an equity stake in the new project which it would then sell once the operation is up and running. That has in more recent times included lithium. Mineral Resources owns the Wodgina mine in the state's Pilbara region and a 43.1% stake in the Mount Marion lithium mine in the state's south. Mineral Resources shares closed at $16.94 on Tuesday, a far cry from the 90 mark the company listed on the ASX at back in July 2006. Outside of Mineral Resources, Ellison is best known for having made what was then the most expensive purchase of an Australian house when he paid $57.5 million to fellow rich lister Angela Bennett for her Mosman Park Riverside mansion in Perth in 2009. He also owns several other properties in Perth, and in nearby beachside locations. Ellison also holds several share investments. His is top 20 shareholder list of Mark Boris investment and wealth management firm Yellow Brick Road Holdings, though its performance has not matched that of Mineral Resources. Yellow Brick Road share are down 17% since January 1, but have at least risen from 9 cents to about 14 cents since mid-June. Mineral Resources has a 43.1% stake in the Mount Marion lithium mine in Western Australia. Photo-supplied Catalonia's rogue independence vote has not been enough to change the narrative in markets as investors remain focused on the economic progression of today rather than the potentially fraught political landscape of tomorrow. On the weekend, a Catalan referendum turned violent after it was declared illegal by the Spanish government. The risk is now either a government crisis or a constitutional crisis, Brown Brothers Harriman strategist Mark Chandler wrote. Against this backdrop, Catalan leaders could declare independence if they feel that they have enough support, raising fears that the region could secede from the rest of Spain. But, reflecting the largely sanguine reaction to the turmoil from markets, analysts remain unconvinced on the prospect. We see secession as highly unlikely, Societe Generale European equity strategist Kevin Reduro wrote. But, he added, he sees no quick fixes either. Both sides are radically opposed, and tensions could rise in the coming days if a declaration of independence is proclaimed. He believes that Catalan separation could continue to weigh on the country's share market. A combination of a minority government and the Catalan independence push might prevent Spain from making much-needed reforms, hence we remain shy of Spanish equities, he said. While there's been a bit of downward reaction for Spanish equities, the euro is little moved and the spread between Spanish and German bonds, often a signal of stress, remains average, Legg Mason affiliate Brandywine Global portfolio manager Richard Lawrence noted. The movement within asset markets, or the lack of it, illustrates current market thinking on Spain, that it's a local rather than a national issue. We believe this particular issue in Spain is more about national identity than populism. The struggle between Catalonia and Madrid has spanned centuries, Mr. Lawrence said. People hold Spanish national flags. Photo Bloomberg New Zealand house prices grew at their slowest pace in 5 years in September as a hard-fought general election and central bank lending restrictions dampened buying. Quotable values residential property price index rose 4.3% in the year to September, the slowest rise since August 2012, after gaining 4.8% the previous month. The Reserve Bank of New Zealand imposed stringent loan-to-value restrictions on bank lending last year to reduce risks to the financial system from a red-hot housing market. House prices in the Auckland region, previously the epicenter of house price inflation, grew at just 0.8% in the year to September, the slowest pace in 6 years. Slow price growth was compounded by an uncertain period around the inconclusive September 23 election, with buyers sidelined as they waited to learn who would form the next government. Neither major party had won enough votes to form a government, leaving the country waiting for populist New Zealand First Party leader Winston Peters to decide whether to support the Labour Party or give the governing National Party a fourth term. While there is uncertainty around who will govern the country in the coming weeks, there are policies that, if agreed upon under a coalition government, could influence the property market, said QV spokesman David Nagel. Centre-left Labour has said it will reduce net migration by almost a third, which would reduce demand for housing, and build 100,000 affordable houses across the country. Prime Minister and National Party leader Bill English signalled in August that he thought that the central bank should consider removing its LVR curbs. The RBNZ said there was a risk the housing market would take off again if it lifted LVR restrictions. There is also the risk that buying could ramp up in the warmer spring weather or once a government has been formed. Auckland, photo iStock. It's lunchtime and the ASX remains deeply in the red, with the benchmark down 45 points, or 0.8%, at 5,655.8. The All Ordinaries is down 0.7%, or 41 points, at 5,722.1. The dollar is at US 78.54. Banks are the worst performers by sector, with ANZ down 1.8% after a broker downgrade. Westpac is lower by 1.1%. NAB is down 1.2% and CBA is 0.5% lower. The big miners couldn't prop up the market on Wednesday, with Rio Tinto down 1.6%. BHP down 0.4% and Fortescue down 1.5%. QBE was taking back some of the previous session's steep losses, however, trading up 2.2% after Morgan Stanley analysts said it's time to buy. A2 Milk climbed 3.7% after it was upgraded to buy at Goldman Sachs' best and worst ASX performers. The RBA reckons things are going pretty well, but there are no shortage of knockers when it comes to our enviable economic record. Here's Satyajit Das. Australia's record of 26 years without a recession flatters to deceive. The gaudy numbers mask serious flaws in the country's economic model. First and most obviously, the Australian economy is still far too dependent on houses and homes. During part of the typical business cycle, national income and prosperity are driven by exports of commodities, primarily iron ore, liquefied natural gas and coal that come out of holes in the ground. At other times, low interest rates and easy credit boost house prices, propping up economic activity. These two forces have combined with one of the highest population growth rates in the developed world, around 1.5% annually, driven mostly by immigration to prop up headline growth. Yet a significant portion of housing activity is speculative. Going by measures such as price to rent or price to disposable income, Australia's property market looks substantially overvalued. Meanwhile, GDP per capita has been largely stagnant since 2008. Australia's manufacturing industry, once a significant employer and an important part of the economy, has increasingly been hollowed out. The country's cost structure is high. Improvements in productivity have, as elsewhere, been lackluster. Infrastructure is aging and unable to cope with the demands of a rising population, especially in major cities. Australia stands at 21st place in the 2017 Global Competitiveness Report. It ranks 15th in the World Bank's Ease of Doing Business list. Attempts to diversify the economy have had mixed results. Tourism and service exports, mainly of education and health services, have expanded significantly. But they're nowhere near replacing the revenues brought in by mineral exports. Second, a debt bomb is growing down under. Read more. Sydney-based former banker turned financial commentator, Satyajit Das, photo. Louise Kennelly back to top. QBE shares are down 20% this year and Morgan Stanley analysts say it's time to buy. The troubled global insurer took another hit yesterday when it announced a $600 million hit to earnings thanks to losses associated with hurricanes in the Americas and then the Mexican earthquake. That downgrade equates to around a 60% hit to cash earnings for this December 2017 financial year, the MS analysts estimate. Most brokers expected QBE would struggle to cover its claims via its established reinsurance contracts, but the size of the blowout surprised the analysts right. Given the expected losses, the analysts do not expect QBE to pay a dividend for this half. But with a solid capital position, the buyback likely resume. Which brings us finally to why the analysts have upgraded the stock to overweight, with a slightly lower 12-month share price target of $12.90. With greater clarity of FY17 earnings, and the market not pricing in FY18 upside from premium hikes, in our view now is the time to buy, they write. With around $25 billion of investments, QBE's yield on technical reserves and shareholder funds stands to benefit from rising yields. On an estimated PE for next year of 9.7, a price-to-book ratio of 0.9 and a 6.7% dividend yield, the valuation is compelling, they say, with the market pricing in all of the downside and none of the potential upside. QBE shares are up 2% this morning at $10.02. US dollar skeptics are dubious about whether the greenback's rally has got legs. Amundi, which oversees more than $1.1 trillion, prefers to wager on European currencies, while Schroeder Investment Management is putting its money into emerging markets. Eaton Vance in Boston says improving growth outside the US could see the dollar resume weakening as it has for most of the year. The US currency rose for the first time in 7 months in September as the Federal Reserve said an interest rate increase in December was still on the table and President Donald Trump announced a plan to cut taxes. The greenback's recovery has been closely correlated with Treasury yields, which have risen for the past 3 weeks. We expect US 10-year yields to drift higher but not to move up sharply, said Rajiv De Mello, head of Asian fixed income at Schroeder Investment in Singapore. If other countries, especially the growth-sensitive emerging economies, continue to benefit from the stronger global economy, the US dollar should be weaker against them. At the heart of the debate over the dollar is lingering doubt over the Fed's ability to keep raising rates into 2018 and investors' preference for emerging markets and Europe over the US's global growth gathers momentum. Hedge funds are skeptical about the greenback, with net short positions climbing to the highest since January 2013 at the end of last month, data from the Commodity Futures Trading Commission show. While Treasury 10-year yields are set to climb to a range of 2.40% to 2.60% in the next 12 months, a global synchronized economic recovery will also boost bond yields elsewhere, making local currencies more attractive, said James Kwok, head of currency management at Amundi in London. The company is neutral on the dollar, preferring to wager on gains in the euro, Sweden's krona and Norway's krone against Asian currencies, he said. Dollar skeptics are dubious about whether the greenback's rally has got legs. Photo Tomohiro Osamu. The $400 million sale of surfwear company Rip Curl is picking up speed, with management presentations underway at the Sydney offices of advisors Gresham rather than Rip Curl's Torquay headquarters, AFR's Street Talk reports. It is understood that co-founders Brian Singer and Doug Warbrick are planning to sell their entire interest in the business they started almost 50 years ago, rather than keep a minority stake. Despite the travails at Billabong, Quicksilver and Surf Stitch, Rip Curl is attracting strong interest from global apparel companies and private equity investors. VF Corp, the owner of brands such as Vans, Timberland and The North Face, is said to be sizing up the company and is competing against a handful of offshore and domestic private equity suitors. However, given the challenging consumer environment, which contributed to the near collapse of Billabong in 2014 and Quicksilver in 2015, and fears about the impact of Amazon, there are concerns that financiers may be cautious. Questions have also been raised about Rip Curl's supply chain following allegations a few years ago that some of Rip Curl's products were made in North Korea. Rip Curl said at the time it was a one-off, unauthorized event and it has since put in place a code of conduct which requires all suppliers to conform to international standards. Street Talk revealed last month that Singer and Warbrick had appointed Gresham and US-based boutique RW Bed to run a sale process. Despite the travails at Billabong, Quicksilver and Surf Stitch, Rip Curl is attracting strong interest from global apparel companies and private equity investors. Photo Kelly Sestari shares have shrugged off yet another positive lead from Wall Street to record broad early losses, with drops in the big banks and supermarket owners weighing heavily. Every sector is lower in 3/4 of the top 200 index, with the benchmark measure off 20 points or 0.4% at 5,682. There is some good news for QBE shareholders, with the stock clawing back a portion of yesterday's heavy losses to add 1.2%. A2 Milk keeps on keeping on, up another 2.4%, alongside a number of smaller mining stocks. BHP has managed to add 0.4%, but Rio and Fortescue are lower. But a 1% fall in ANZ following a broker downgrade and falls across blue-chip names has pushed the stock market into another disappointing start. CBA has eased only 0.2% after a broker upgrade. Woolies is down 1% and Wesfarmers, which owns Coles, is down 0.6%. The Aussie dollar, which dipped as low as US 77.86 overnight, is at US 78.3. Winners and losers in early trade. Photo Bloomberg. The growing deadweight of Australia's 5-year debt binge has only just started to drag on economic growth and jobs, according to modelling by the International Monetary Fund that further highlights the increasing financial vulnerability of households. With the Reserve Bank of Australia holding the official cash rate steady at a record low 1.5% for a 13th straight meeting on Tuesday, the IMF's findings indicate that deliberately encouraging households to take on more debt delivers only a temporary sugar hit. Based on a study of more than 80 advanced and emerging economies, the IMF finds that any positive effect of an increase in debt is reversed after 3 to 5 years. It suggests that a 5% increase in the ratio of household debt to gross domestic product leads to a 1.25% fall in real GDP 3 years ahead, and rising household debt is correlated with future falls in private spending. These findings suggests that household debt booms finance consumption expansions, often through current account deficits that revert later when consumption and GDP growth also decline, the IMF's economists said in a report published in Washington on Tuesday. Increases in household debt are also associated with significantly higher unemployment up to 4 years in the future. The findings underscore how much Australia's economic expansion since the end of the resources boom in 2012 has involved a trade-off between the short-term benefits of debt-driven house price gains against the longer-term negatives of weaker growth and risk. Household debt and access to credit can help boost demand and build personal wealth, but high indebtedness can also be a source of financial vulnerability, the IMF economist said. For a country such as Australia, where households have a debt-to-income ratio of more than 190%, servicing the burden can cause significant debt overhang problems when a country unexpectedly faces extreme negative shocks, the fund said. The growing deadweight of Australia's 5-year debt binge has only just started to drag on economic growth and jobs. Back to top, the CBA manufacturing PMI survey edged up to 53.8 in September from 53.5 in August. The CBA Services PMI survey fell to 53.2 points from 54.2 points in August. Readings from both surveys remained over the 50 mark, which separates economic expansion from contraction. The PMI stabilized in September after declines in July and August. Manufacturing activity is still expanding, but it appears that the period of acceleration is over. Nevertheless, panelists report that economic conditions remain favorable, and this positive view extends to expectations for the next year, said CBA chief economist Michael Blythe. The services sector is experiencing the same rapid increase in input costs as reported in the manufacturing PMI. But services have been more successful in passing this cost increase through to prices charged. This outcome suggests that the demand side of the services equation remains resilient. The Commonwealth Bank manufacturing PMI edged higher from 53.5 in August to 53.8 in September. Photo Dominic Lorimer Morgan Stanley analysts have downgraded ANZ to equal weight from overweight. They cut their fiscal year 2018 margin forecast by around 5 basis points for the bank, for a couple of reasons. Institutional banking remains competitive, and the expected margin recovery from rebalancing is not eventuating, it said. In addition, ANZ gets less benefit than peers from home loan repricing, and may need to compete more aggressively to prevent market share loss. Also, ANZ's geographic and deposit mix reduces its leverage to lower funding costs, the Morgan Stanley analysts believe. They said that they are no longer confident of a revenue rebound in fiscal 2018 given margin headwinds, slowing housing loan growth and elevated first half 2017 markets income. Revenue forecasts were cut by around 2%, and the analysts now expect another flattish year-on-year outcome in fiscal 2018. While we believe company-specific problems of 201,617 have passed, our estimate of risk tendency confirms that ANZ still has the highest risk profile of the majors, and that the current gap to normalized loss rates is actually greater than peers. We also think it has more exposure to pockets of weakness, and our AlphaWise survey indicates that its mortgage customers have the highest average DTI ratios. We believe the cost-out story extends beyond the restructuring of the institutional bank in 201,617, and that an around $9 billion group cost base is achievable in FY19, assuming underlying expense growth of around 3% is offset by cost savings, they said. In the absence of further non-core asset sales, they don't expect a buyback until 2020. ANZ has re-rated since CEO Shayne Elliott announced decisive steps to create a simpler, better capitalized and more agile bank. The price-to-earnings multiple is now near the top end of its post-2009 range, and the discount to peers has narrowed to just around 3%, which is in line with the long-run average. Morgan Stanley downgraded ANZ. Photo Carla Godgins. All the overnight data in numbers. SPI futures up 15 points or 0.3% to 5,694 Australian dollars, 0.1% to 78.36 US cents. Range 0.7786 0.7839 on Wall Street. Dow 0.4%, SP 500 0.2%, Nasdaq 0.2% in New York, BHP 0.5%, Rio 1% in Europe. Stocks 50 0.1%, FTSE 0.4%, CAC 0.3%, DAX 0.6%, spot gold 0.1% to $1,272.21 an ounce. Brent crude 0.2% to $55.99 a barrel. US oil 0.3% to $50.44 a barrel. Iron ore flat at $62.05 a ton. Chinese markets are closed for holidays this week. Steam coal 1.1% to $97. Met coal 0.0% to $179, LME aluminium 0.4% to $2,130 a ton, LME copper 0.4% to $6,520 a ton, 10-year bond yield US 2.33%, Germany 0.46%, Australia 2.84%. On the economic agenda today: AIG performance of services September, ANZ job ads September, Japan Nikkei services PMI September, Eurozone market services PMI September, Eurozone retail sales August, UK market trips services PMI September, USADP employment survey September, market services PMI September is a non-manufacturing September. Fed speakers Janet Yellen, James Bullard stocks to watch: A2 Milk Co raised to buy at Goldman, APN Outdoor raised to buy at UBS, CML Group new buy at Canaccord, Commonwealth Bank raised to buy at Bell Potter Trading ex-dividend, Aspen Group Collection House, Redial Education. US stock indexes touched new record highs overnight, boosted by rally in tech stocks and gains in Ford Motor and General Motors after strong September vehicle sales. A solid month of car sales in September in the U.S. bolstered industrial stocks, helping lift the Dow and S&P 500 to fresh highs, while a rebound in tech stocks bolstered the Nasdaq. The sales news came a day after a report showed manufacturing activity is surging. On Wall Street, the Dow finished the day up 0.4%, the S&P 500 rose 0.2% and the Nasdaq advanced 0.2%. The debate over the prospect of tax reform in the U.S. included billionaire Warren Buffett and BlackRock boss Larry Fink. In separate interviews, Buffett said he expects tax changes to succeed as Republicans are keen to end the year with a legislative win. Any politician that can't pass a tax cut probably is in the wrong line of business, Buffett also said. However, both Buffett and Fink said they expect the proposals to be changed before they can be passed. Fink said he was wary of the cost of the tax cuts adding to the deficit. Both Buffett and Fink also sounded cautious optimism about stock valuations. While Fink said markets are fine and will do well until the end of the year, he noted that he sees more value outside the United States. BlackRock manages $5.7 trillion. Fink said he expects Trump to nominate more moderate candidates to serve on the U.S. Federal Reserve than Republicans have in the past, likely portending no major changes in the direction of monetary policy. In European trading, the blue-chip FTSE 100 index ended the day up 0.4%, outperforming European markets. The pound's tumble to a three-week low drove gains in the index dominated by foreign-earning international firms. Construction sector activity fell in September, and comments from Brexit Minister David Davis at the ruling Conservative Party conference added to uncertainty for sterling traders. Tech and auto markers lifted Wall Street to fresh records. Photo Mark Lenihan. Good morning and welcome to the Markets Live blog for Wednesday. Your editors today, Sarah Turner and Patrick Commons. This blog is not intended as investment advice. Fairfax Media with wires. Back to top.